Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how to sell at the top and buy at the bottom. In this session, we will be looking at one of the oldest adages in trading: sell at the top and buy at the bottom. How can this be implemented in your trading to maximize results? 20 years ago, financial markets, including the foreign exchange, were driven by fundamental analysis over technical analysis. That is to say that professional traders and analysts would base their trading around fundamental economic data, including policy-making decisions, interest rates, GDP, inflation, and political events including wars. Technical analysis was in its infancy. In these times, it was much easier to predict where the bottoms and tops of assets were likely to be based on the fundamental reasons alone. Today, things have completely flipped to the opposite side. Technical analysis is heavily dependent upon, where chart patterns dominate price movement and where fundamental reasons for trading often lag behind technical and sometimes seem to defy logic. You only have to take a look at the Dow Jones 30 Industrial Average Index, which is at an all-time record high, breaking over 30,000, while the US economy is still struggling because of the pandemic, which it still is in the grip of. Fundamental analysis has gone out of the window on the basis that technical analysis is fueling the US stock market. The hopes of the vaccine rollout outweighs the fact that the hospitals currently are at extremely high levels of COVID patients. New records were broken and all-time highs were reached, despite the fact that there was over 3,000 deaths in a single day in the United States. Similar circumstances, albeit non-pandemic related, perhaps more to do with the overpriced stock market fueled by the success of the 1920s, where share trading on a margin was rife, probably caused by the famous 1929 US stock market crash, which took years to recover from. Currently, the US stock market is also buoyed by the hopes of extra stimulus by the federal governments, and where this money is finding its way into the stock market. Even so, the market is overbought, and it does not comply to the earnings per share. Despite this, it is still relentlessly bid. Even so, where is the top? It is difficult to say in this hyped market, which is pulling back from every attempt to short it. If the market reaction is so extreme and fundamental analysis is second to technical analysis, traders have to be on their guard and look out for several signs that the market is topping out or bottoming out. They must do this in order to find a good entry point to trade in either direction. In this daily chart of the GBPUSD pair, we can see a huge push lower at position A during the middle of March 2020, where Britain began to fall into the grip of the coronavirus, which plunged the exchange rate down to 1.1400. Buyers were looking for an opportunity to go long because this was seen as the bottom of the bear move. We have the high in September at position B, where there is a spike outside of the Bollinger Band. The candlestick is an upturned bearish hammer, and where the subsequent candlesticks are bearish, providing traders with the knowledge that this is potentially a top at 1.3485. A subsequent high at position C with a bearish hammer spiking out to the band provides chartists with a potential top at 1.3535. By incorporating these simple chart lines at positions A, B, and C, it helps us to visualize trend reversals. Once we have one or two candlesticks on the daily chart confirming that there is indeed a trend reversal in progress, we can drill down into lower timeframes as intraday traders in order to look for opportunities to go short or long. We must never ignore the fundamental reasons for taking a trade on. However, based on what has been set out today, we must conclude that fundamental analysis often lags behind technical analysis, and therefore by looking at swings in price action forming tops and bottoms outside of periods of consolidation, traders give themselves a better edge while stacking the odds in their favor. In conclusion, we are in an age where fundamental analysis often has no bearing on asset price, and where technical analysis and fundamental analysis are often out of kilter. But where eventually will these two catch up with each other? A trader's best opportunity of bagging more pips must be centered around reversals in price action based on longer timeframes, such as daily charts, before drilling down into lower timeframes such as hourly charts and trade in a direction of the daily chart trend. You do this in order to stack your odds in your favor. Never forget the importance of the fundamental reasons why a currency pair exchange rate might potentially be changing direction. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.